Hey, this is Chris. Now, it's been about 2 years since we launched our sustainable portfolios, and they're becoming very popular. I think we had about 100% growth in new clients using the sustainable portfolios over the last year. So I wanted to share a few of my tips about thinking about sustainable investing and a few of the do's and don'ts that are going to set you up for success if you decide to invest in this way. So first of all, a few of the do's. So, like any sort of investing, we strongly recommend diversifying if you're going to be a sustainable investor. It's still really important to be spreading your money across different sectors and assets and countries for the same reason it is when you're investing in a typical index portfolio, which is that it helps to guarantee that you own the winners and also helps to smooth that path over the long run. So don't think just because you're investing sustainably, you only need to invest into a few companies. That's an extremely risky strategy and not one that we'd recommend to anyone. The next one is dollar cost average if you can. Like with any investment, it makes sense if you have the opportunity to gradually invest over time because it's going to help to average your investing in over a period and help to smooth your entry price into markets. And particularly at the moment, we're seeing quite volatile markets and people worried about not timing the bottom or wanting to make sure they have an opportunity to buy if markets fall further. Dollar cost averaging helps with that psychologically because it means you've always got a little bit of extra money to invest if markets fall. Another tip would be to just make sure that your investment strategy aligns with your goals and investment horizon. So, not just to invest for 6 months or a year, to make sure that you've got enough time on your side to actually see the results and the returns. Because when you invest in any way, and sustainably included, you really need a bit of time to be able to see the long-term trend as opposed to the short-term noise of the markets. And then the other do I would say is that we see a lot of sustainable clients that are really interested in the sorts of companies that we're investing in. So if you are interested, take the time to learn a bit more about the businesses that are underlying these index funds that we're investing into. There's a whole bunch of very interesting companies in the index of sustainable companies that are different to the traditional index that you might want to learn a bit more about. For instance, in the Australian shares sustainable ETF that we invest into, there's quite a large amount in lithium and battery technology companies and companies that are mining these sort of materials. That's an interesting area that it's worth learning more about and to understand why that's becoming a bigger part of the market. So if you're fascinated by this sort of thing, you can find that information either on our dashboard if you click through to the underlying ETFs, or by looking further on their websites. You can actually see all of the underlying holdings and what sort of businesses they're operating in. So they're the do's. Now a few don'ts. Now, we do see sustainable investors sometimes that expect returns to come straight away, and like with any type of investing, returns come pretty slowly, and there are also going to be periods of markets falling. So sustainable investing doesn't make you immune to market forces, and markets do go up and down over the short run. We've recently seen markets fall a little bit, and that's perfectly normal. And then over longer periods, don't expect that always sustainable investing is going to give you a better return than other types of investing, like just investing into the broader market index. What we have seen over the last 10 years is that sustainable investing had a really good streak of better returns. And this was due to the underlying sectors that sustainable portfolios have more of. So they tend to have more biotechnology and technology shares and less energy and resources shares. And actually between 2010 and 2020, the technology sector did a lot better than the mining sector. But that might not always be the case. And currently with commodity prices rising and energy prices rising, we're seeing the opposite. We're seeing energy and commodities doing better, technology not doing as well. And therefore, a lot of these sustainable investments aren't doing quite as well as the broad market index. Look, our advice would be don't just switch to the other type of investing just because it's doing a bit better over the short run. There's always going to be periods of one doing better than the other. That's something you need to understand and accept if you're going to invest in a sustainable way. But it's probably going to harm your results if you just switch from one to the other, because you'll probably do it at the worst time. You'll probably see sustainable underperform for a while and switch to the index, and then see that underperform and switch to sustainable, and you'll never really get it right. So just stick with one and understand that there's going to be periods of doing slightly better or slightly worse. My other tip with sustainable investing, and this goes more broadly to anyone looking across all types of investments, is make sure you're not paying high fees. So in the past, one of the gripes I had with ESG and sustainable investing is it always seemed to have much higher fees attached. And we know that over the long run, fees are your enemy. And I actually always believed it was quite unethical of these ethical investing companies to be charging such high fees because their own customers were getting disadvantaged by these high fees. These days it's improving and we're seeing a lot more competition, which is bringing down the prices and fees for a lot of these sustainable products. Certainly it's something we're very conscious of, and when we selected the ETFs in our sustainable portfolios, we made sure that they had fees that were fair and reasonable. But if you are looking at different types of ESG funds, be conscious that every dollar you pay in fees is a dollar that's going to come out of your returns, and it's something you still need to be thinking about. And just because they're investing in a sustainable way doesn't mean you should have to pay more. I don't think that's fair that you should have to pay some sort of green tax for really, investing in a certain style. And so it should be something that everyone's aware of and conscious of when they look to invest sustainably. And they're my do's and don'ts when it comes to sustainably investing, and particularly tips that I see from questions we get about the Stockspot portfolios.